All right, so we are recording. I just wanted to let everyone know that this will be recorded. And I'm gonna get us started and do the introduction. So good afternoon, everybody. This is our fourth seminar of the Jewish Federation's Professional Advisory Council for the 2020-2021 year. This one is entitled Intergenerational Charitable Planning, What's the Plan? My name is Shannon Small, and I'm the Financial Resource Philanthropic Officer for the Jewish Federation of Nashville. I will be facilitating and moderating today's seminar. So most of you know our PAC is a group of attorneys, accountants, financial planners, insurance brokers, and wealth advisors that provide education to the Jewish community related to wealth transfers to families and for charity. The Jewish Federation, along with our partner organizations, have asked our supporters, some of you here today, to sign letters of intent indicating you're planning on leaving an after-lifetime legacy gift. Some of you have chosen to leave it during your lifetime, and that will leave a long-lasting impact to the Nashville Jewish community for future generations. There are more than 770 letters of intent. It's about $21 million left in gifts to the Nashville Jewish community. Sorry about my dog. 67% of those letters have been formalized. And this program is sponsored by the Jewish Federation of Nashville in partnership with the Harold Grinspoon Foundation. And I just wanted to thank you all for your support. I will be emailing out, the slides and the video from today's presentation if you want to share with anyone or keep for your own records. And please use the chat feature if you have questions during our question and answer. I will be tracking all the questions and make sure that during our Q&A they get asked. You can send them to everyone or just send them to me if you'd like to remain anonymous, that's fine too. So there's two short presentations, it's 3 speakers, but 2 presentations. For the first half, our second half, as most of you know, is question and answer. So our first presenter is Eva Poli. She is a senior manager in the Tax Services Department of Kraft CPAs. With 33 years of public accounting experience, she specializes in estate and trust planning, taxation, and administration. She oversees the accounting and tax services for several corporations, partnerships, estates, and trusts, as well as individuals. So we have 2 presenters for our next presentation, Michael Whitney and Brian Langdon. Michael has been educated and licensed to help individuals and families with transferring risk through insurance and growing wealth through investment. He enjoys helping families understand options and actions they can take today that can offer benefits later in the future. Every profession has its own language, and Michael enjoys helping his clients understand the language of planning. He has an MBA from the University of Southern California and holds a Chartered Retirement Planning Counselor designation. And where he works, Wise Family Wealth LLC is a member of the Commonwealth Financial Network. For our last presenter, Brian Langdon, his career in the insurance industry began when he started as an agent at Pacific Life. And after being an individual representative there, he moved into management with Guarantee Trust Life in Illinois. And at that point, he managed the senior market sales for the Southeast and eventually assumed the position of vice president of agency sales. In 1999, he moved to the long-term care division of New York Life, where he started in brokerage, moving to the captive division and eventually became vice president of sales. He joined Ash Brokerage in 2011, and he now focuses on long-term care planning with an emphasis in asset-based solutions. So with all of those bios and intros, I'm going to ask Eva to start. I am going to share my screen so that for her presentation while she speaks. So if everyone just give me 1 minute, I'm going to find her presentation. And
okay, thank you, Shannon. And thank you for having me as part of the presentation today. My part is not a technical issue. It's something that we all know, and we know people that are generous and we know people that are not. So what we're wanting to talk about today is just how to pass this on to the next generation. We know that a lot of people are generous by nature, and we also know some people are not. as a tax preparer, and Shannon, I need to update my bio. This is my 35th year. It's like these years are going really fast, but I see the tax returns of multi-generations as the planners do when they're discussing the wills and the reasons they're making changes for the wills, or power of attorneys. They may change who they want their power of attorney to be. Life changes. So when I see these multi-generational differences, say the senior generation, I see the sizable donations and their kindness towards helping nonprofits and other agencies. And then I can have the same household and I'm preparing their children's returns. They're in their 40s and 50s. And I see extremely low charitable gifts, complete daylight and dark difference between the two generations. And so it is important to have that talk with your family. So we look at, philanthropy. We talk about family philanthropy and family legacy and generosity. And so we think, well, this family's got a plan to be philanthropic and this or that, but is it part of the overall plan? Is it in the nature of the people that are carrying out the plan to be generous? So I've had this arranged here. You got family philanthropy, family legacy, generosity, or is it backwards? You start with generosity, you build a family legacy, and then you have the family philanthropy that comes to follow. And I think the latter part is the correct way. You have to start with the generous nature, and then the others will fall into place. So if we look at generosity, what is generosity? It's giving more of something than is expected or necessary. And it doesn't always have to be money. It can be time. Most of the time we think of money, but it can be time. Like I said, as a tax preparer, I have several clients that as they age, they either did not have family, children or nieces and nephews to help with their later years tax preparation. And I've got several clients that their neighbors are the ones that go over and help them gather all of their tax information. They drive them over here for their meetings, or they bring everything, they answer every question. They're given their time when it's not necessary. It is necessary because there's no one else to do it. But it's not expected that your neighbor will take on your responsibilities. And so that's a generous nature. Terms that we use a lot is helpful, thoughtful, compassionate, caring, unselfish. You hear big-hearted, and that's where these neighbors come into that. So it's their time that they're using and giving away unselfishly, just wanting to do what's good and what's right to help a neighbor. Generosity is a trait that must be learned. Children, as you know, from having young children, that when it comes to time to play with toys, their nature is to be selfish. They do not want to give up the toy. They do not want to share the toy. So it's a trait that must be learned. And you learn that by seeing and hearing others display this virtue. It's something that they may not even realize what they're acknowledging until years later. And we all live by example. They say, well, a lot of times parents will tell their children, well, I did not raise you that way. I did not raise you to do this, this, or this. And you're somewhat correcting the child or disciplining the child. But in reality, they may be having friends at school or college mates that are influencing them. So what we do at home is just a portion of what develops their character and their nature. So we have to do all we can from home to instill in them the moral standards that we have, the giving heart, the kindness to others, because they do run into other people that will have things to influence them. So we want them to live by our example as much as possible. And when I think of that, I look at just as a couple of examples. As a child, my father would always pay for the dinner. If we went out to dinner and we had people with us, he would pick up the tab every time. And, there was no questions asked. He was just going to do it. That was his nature, was to buy the dinner for everyone. My brother does the same thing. We do occasionally. It's one of those things, a lot of times we all go as family units, but everyone takes care of their own family. My one brother just will not let that happen. He takes the ticket for everyone, but he did the same thing. If he had a garden, I'd be here at my office at Craft, and he would come by and say, "Come downstairs, I've got something for you." And he would hand me huge bags of squash and cucumbers and fruits and things I'd never seen before that he had grown. He was constantly sharing and helping others. My mother, she was the type that would give away anything. If you came in our house and said, "Oh, I really like that. That is so pretty," she's going to try to give it to you before you get out the door. And you would have to insist, "No, no, no." You had to be careful when you admired something, because she wanted to gift it to you if you liked it. As she got older, she would bake cakes and take them to the bank. She wouldn't get out the door with a cake when we were little because it would be gone. But once we were all out of the house, the bankers got cakes quite often, and they would love it. They would say, "Oh, here comes Miss Ruby with a cake," because she would take it to them to share. In that nature, I had an uncle, it became obvious, right the opposite. Never offered to, in our family gatherings every time he was there. And as children, you notice the people that are generous and the people that are not. It's just seen. So we want to make sure that we live that example so they can see it, because they may not ask you questions about it. So some tips for passing on the generosity is talk. I got talk, and listen. We can be all the talk, but we've got to also listen to the next generation. We tell stories, like I just gave an example of how my parents were. We can tell stories of generosity or how your grandparents were, and pass those down, and that's wonderful. But we also have to listen to what they have to say, because we may want to, and they're not going to just voluntarily come in and start talking about charitable giving and whatnot. That's just not usually going to happen. So we have to kind of pull it out of them. And you could start with asking them, what do they see as an act of kindness? Or even if they're little, I started very young with my daughter, is, "Well, what happened today at school?" or whatever. And you can ask, "Did somebody do something kind?" "Well, so-and-so, did this or that and helped Susie, and well, that was nice." So even as simple as that sounds, we engage them in the conversation of what being generous is and helpful. And two, share what's important to you. The Jewish Federation obviously is known to a lot of people, but they may not realize why it's important. They know the name, they know some basics about it, but you may need to share the history with them. You could have another one, the animal rescue or whatever. Explain to them why it's important to you, not just that we give to these 10 charities and that's what we do every year. They need to understand why, but also encourage and support their passions. They are not on the same page we are. We love them, they love us, but what they perceive as important is not what we may perceive as important. And in your own life, I'm sure you've seen too, what was important to me when I was 20 was not the same thing as when I was 50. And so it's just needing to be known, because we expect that, well, I've always liked this charity, so you should. That's not always the case. I mean, it's not that it's a bad charity, but they have a different view, and we need to let them express that. as I said, let them see you being generous every day, one way or another, whether it's the helping the neighbor or buying someone's dinner. We hear of people going through the Starbucks line or whatever and paying for someone's coffee behind them, don't even know what they're paying for, but they're paying for it. And a child in the car will notice that. Even though it's maybe small in a monetary amount, they notice that you helped someone you did not even know. And it is without expecting anything in exchange. So one of the things that I think is very helpful is plan a gathering to discuss the charitable intent. What is the intent behind doing this? What's the purpose for the giving? And I attended a seminar, it's been a few years ago now, and it was on private foundations. And one of the presenters there discussed something, and then I've started using it myself. And what he said was, at Christmas time, he would talk to his family and say, you get to select the charity this year that we will make a donation to at Christmas time, but I need you to research the charity, come up with why you would want to give it, how the money is going to be used, and things like that. And so I did that myself, and it's nice to let them choose the charity. And now mine were older, so I asked them to just put a little note so that when I put the check in the envelope, there was a note that they had selected this charity to receive a Christmas gift from our family and why they selected it and what it meant to them. So let them get a little bit more involved than just saying Nashville Humane Association because I like animals. Okay. So also volunteering in the community. Like I said, make it a family project, whatever it is. If it's picking up trash on the road, just volunteer and get the children involved. There's a lot of different projects going on. And obviously with the tornadoes we've seen an outpouring in Nashville of generosity of people's time and energy, helping with cleanup and helping their neighbors. I've got here, fund the next generation's education. It would, and I know sometimes privacy is very important and parents do not want their children to know every aspect of their finances, but it's important for them to know that we are funding your child's education as an indication that you may fund your children's education, that it's something to help out the next generation down. Even though it's not a charitable item, it still is that generosity that they see that you did not have the responsibility to educate your grandchildren, but it's a generous thing to do, and it instills that generosity in them. I've got to acquaint yourself with others that are generous. Same reason. When you see other people's generosity, it makes you feel good that they were generous. And like I said earlier in the example of children going to school, who do you hang around with? Who do you come in contact with? Are they generous as well? And that does help develop that nature of generosity. So from being generous, we look at the family legacy. What do we want people to remember about us? The family legacy, it's more in line with what are our family values, our family stories, our history. You know, we've all been in the situation to where you see one generation being extremely generous, the next generation waste what's inherited. You want to instill this so it will continue from generation to generation. So that's what develops a family legacy, is the continuance of that. So what will they remember? The time you spent with family and friends, was it valuable? Was it helpful? Was it only whatever you could get by with? What was an absolute necessity? Now, I know as a working mother, I had for years felt really bad that I couldn't spend every moment with my daughter. But I also realized having her in daycare was a tremendous help for her. She was an only child. We lived in a neighborhood that did not have young children. So for her, that was her social gathering. She would tell me when I would pick her up, I would try to get to her as soon as I could. And as she got a little bit older, she would say, Mama, why are you picking me up so early? I want to be the last one here, because she liked being there playing with the children. So even though the time I thought was not as valuable, she still enjoyed that time with her friends. So you need that as well. Lend a helping hand, like the neighbor, helping someone. They're going to remember, Mr. Jones always came and helped with the lady down the street, mowed her yard or whatever, helping someone without the intent of anything to come back to you. Are they going to remember that you were an influence in the community? Do people know you? We've all attended funerals before that were standing room only. You go to the synagogue and there, you've got to stand in the back because there were so many people there that thought well of the deceased person. And that's what you want people to do. What do they remember you by? Now, what will they remember your children? Here's where the legacy part comes in. Are they good stewards over what they inherited? They may be, they may not, but they've got a better foundation to be a good steward over what they inherit if they see how their parents dealt with their own finances and outside of their finances in helping neighbors and helping in the community. So, are they going to say, John is just like his dad. He's still giving and helping, and he just stepped right into his dad's footsteps and continued that same program. Will they enhance the family giving program? The intent is that the next generation will generate more. We do see generations that decrease what they received, and then there's a decline going from generation to generation. We would hope that that would not be the case, and they would be good stewards of their inheritance, and they would enhance the family giving program. And we want them to be remembered as they're passionate about helping others, just like their father and grandfather was. You want that to become a trait, because it says a true legacy is the actions that resemble one another and lived out in each generation. You don't want a one-shot deal with, that one family member was generous, but the rest was not. That leads us to the last point, family philanthropy. Well, I'm wanting to be philanthropic, but how do I know it will continue? Once I'm gone, how do I know my children will continue it? Well, you can establish documents now to put that in place. It's not that you don't trust that they will not continue it, but it can be put in place now, and there's good reasons, tax-wise, and setting that example for the generation. So we're looking at donor advised funds, and those are a good one to involve the children now rather than waiting until you've deceased. You could set up a donor advised fund, and say you put $50,000, for example, in it, and you've got 5 grandchildren, and you say, now this year I want you to decide the charity that's going to get money out of this donor advised funds, and maybe tell them a percentage or dollar amount. And like I did with the little Christmas giving fund, this is already set aside. So it's going to be there the next year. If you're not there, they would still remember back and say, you remember Grandpa told us to pick out a charity, and there's this much money in the fund. Let's do it again this year, even though he's not here. So you establish that ahead of time. The charitable lead trust, you can do the same thing there. The charitable lead trust, I won't get into the complexity of it, but it's a trust that you would set up. You can set it up at death if you choose, but you can set it up now to where the income goes to the charity. But at the end of a certain term or a certain situation, it would then go to your heirs, your family members. So same concept. The income is earned. This year it earned $15,000. We have to give it away. It's one of the requirements. You're going to give away the money from the charitable lead trust. That's the purpose of it. And so the family can be involved in selecting those benefactors. Private foundation, there's more involved with those. Same type of thing. You've got maybe a board or directors that would direct where the money is to go. You can maybe make that selection while you're living, then the board would continue it later. So you want to be able to set these up to where they're there down the road if need be. So you're looking at, should I give now or later? I need my money to live on, but I do want to be philanthropic. So what should I do? So the answer is review. You need to look at your income tax plan. You need to look at your estate tax plan, and you need to look at your insurance needs. So from an income tax standpoint, and we've talked about this in several of our presentations, is I have a huge IRA and I can make qualified charitable distributions out of that. I can be charitable minded now and go ahead and save income tax. And like I said, involve your family. It's all in a privacy issue, but how much can you divulge and say, I want to make a distribution this year out of my IRA of $20,000. What charities do you think I should give it to? Just open up the conversation is the main thing. The estate plan, obviously you can make a specific bequest to a charity or set up a charitable lead trust like we talked about just earlier. The insurance, and our next speakers are going to get into that more, is you could make the beneficiary the charity. And so there's a lot of things you can do now and not have to wait till you pass to go ahead and let the family see that you are charitable minded, that this is your nature. You hope they will continue it and share it, and you will see it before you pass, because you know someone when you see them, if they're charitable or not, or if they have a kind nature. So my main takeaway is meet with your professional advisors on a regular basis, because things do change. And that's the main thing is it's an active involvement. It's not, I drafted my documents and they're in the drawer and this will all be taken care of later. It's active. And as I started with the first part, you've got to talk, and listen. It's get them involved while you can, and they will, I'm sure, carry out your wishes if they see that trait in you. That's all I got, Shannon.
Thank you, Eva, for your presentation. Just a note before we get on to our next speaker that if any of you or you know anyone that wants to have that family philanthropy charitable conversation, that the Jewish Federation and Jewish Foundation is a resource to hold those types of family meetings. We have resources available and are trained in being able to facilitate those family conversations. Sometimes advisors as well can facilitate those conversations. So I just wanted to make a note of that. And we're going to go ahead and Michael, I do have your slide, so I'm going to go ahead and put it up for you, and then you can get started. Give me one sec, and I will get that up for us. All right.
While you're getting that, Shannon, let me start by thanking you for all the work you do for all of our seminars and how marvelous that's been facilitating this for the community.
Thank you, Michael. I appreciate that. I am trying to, it won't come up on my share screen.
You want me to see about getting it on my screen?
Yeah, you can also try to get it on your screen. I don't know why it's not showing up. It's very strange. I'm looking. I think you're good then. So let me just put the spotlight on you.
You got it?
Here we go. Yeah, you are spotlighted and ready to go. So Michael, you can get started.
All right. Again, thank you, Shannon, for all the help. And you know, I'm so delighted in advance with Eva's presentation as she's talking about working with children and how important it is to start early to help build a sense of community, a sense of generosity, and those things that come from the parent. And with Wise Family Wealth, we work with something like 150 families. My colleague Rick Carlson and I are together. I started with long-term care insurance in 2003. And I'm delighted to have Brian Langdon join us. And Eva, to go back to what you talked about many times, is that I have found that Brian is a wonderful spirit in terms of his ability to listen. And then by listening to the questions he's getting, help an individual, help a family begin the process. So begin what process? Long-term care, it's an event, it's not a product, and it's helpful to have a solution ahead of time. And really big issues are, how does this impact my family? And I think what we have seen is oftentimes it's the child who may live nearby, and usually it's a daughter who winds up taking a lot of the burden. So in other words, the impact later in our lives of an event of needing long-term care does impact and can cause a lot of disruption, which leads to talk together. Now, Ivo brought that up as well. And what's so interesting to me here is that the kids are now grown up. And now they can help their parents. The parents now have become grandchildren. So I want to give you a couple of examples of experiences I've had of a family working together. In one case, it's a mom. Now she's a grandma. She has two daughters. They're single moms. They both have children. And what they decided with the daughters and their mother, now the grandmother, got together and say, we need to do something. We need to have a plan. And what they worked out is a life insurance policy for the grandma that would help them, the children, pay for her to have long-term care now. So it kind of restores the money that they're putting out at this time and will come back to them. And that's a solution. Now, Brian Langdon is going to talk about the way the long-term care has evolved. So there's more than one solution of that nature that I've just brought up. Another family, and I've worked with 4 generations of a single family, and I was absolutely fascinated by the daughter. So the daughter was living and taking care of her mother and father. And at the end of her parents' lives, the mother had a long-term care policy and never used it. And on the other hand, her father had savings in a retirement account, and her constant worry is he going to use will he have enough money to support him for the rest of his life? And what we came with as a solution there is, and the daughter said, I don't want anything to do with long-term care. My mother had it, she paid for it, and she didn't use it. A solution that came into place was one of the newer type products that enables the money that the daughter has committed to her long-term care plan that will come back to her children or provide her with the money to pay for her own long-term care event, should it happen. So with that, I would like to pass on Brian to you because Brian's going to go over a lot more here in a more technical level. So Brian, go ahead.
Michael, I just need you to stop sharing so that Brian can put his presentation up.
There we go.
Can everybody see the screen?
Yes.
Yeah, I can see it.
Good. There we go. So we're going to talk a little bit more technically about long-term care today, about what it is, why planning.
I'm not seeing the screen yet.
You don't see it?
No.
I see it, so I don't know.
I see it. You know,
Yeah.
I have it on my desktop if I need to get it.
It seems like people are seeing it, Marty.
Okay, it's my issue.
Okay, and you could always try joining like by your phone as well, and we can let you in if you need like a different way of looking, you know. I'm happy to let you back in.
So we're going to talk about what long-term care is from a technical standpoint. I think a lot of people, and I've been doing this since 1984, a lot of people will automatically, when you think long-term care or hear the phrase long-term care, you'll think, wow, that's nursing home insurance, or that's going to a nursing home. And what long-term care is in a bigger stance is it's help with activities of daily living, help with eating, bathing, toileting, continence, transferring, dressing. In today's world, long-term care would be assisted living, home care, adult daycare, custodial care, care when you slow down. It is not skilled care. And when I briefly talk a little bit about Medicare, you'll understand the difference between custodial care and skilled care. And as I said a little bit before, it's just not nursing home. In fact, in today's world, if you happen to have a long-term care insurance policy, 90% of insurance dollars go for home care to reimburse for people to be able to age and live at home. So let's talk about why planning is important. And we live in a different era than our parents and our grandparents. And then, as you can see, life expectancies continue to improve. And when you combine life expectancies, longer life expectancies, with the number of baby boomers that we have out there, it's going to create quite a dilemma for long-term care delivery. Again, whether it be in a nursing home, in an assisted living facility, home care, the access to home care workers, or adult daycare. Not only do we have a bigger generation, the baby boom generation of 75 million people, but they're living longer. And so as we live in a demand economy, when supply doesn't keep up with demand, we certainly understand what happens to price. And certainly extended care is expensive today. As you look at these numbers, now these numbers are from a cost of care study, and they're the general numbers throughout the United States. In larger metropolitan areas, you can expect the cost to be a little bit more. I do point out that the home care cost you see on your slide today of a little over $50,000 is for 44 hours a week of care. If any of you out there, and I have in our family, where you've really tried to actually take care of somebody, you do understand that 44 hours a week is probably the bare minimum. 88 hours a week would get you about 12 and a half hours a day. Certainly you could keep somebody at home with that, but that would double that number in the process. And a private room in a nursing home today is expensive, and obviously only getting more expensive. And you might take a look at this of where costs are going to go over the next 15 years to 20 years. I certainly have inflated the number at 5%. I know I had a close family member in my community a couple years ago in an assisted living facility, and I had the opportunity to speak to the head administrator. And I said, what are you telling families in this assisted living facility to expect in cost increase over time? And he said, well, we do a minimum of 5%. He said over the last 7 years, it's been anywhere from 5 to 7%. My next question was, are there any availabilities in this facility? He said, no, we're completely full. Again, going back to that idea of supply and demand when it comes to long-term care delivery. So you look at a short 3-year stay, and I think last week when we did our kind of prep call for this discussion today, I think Shannon made mention that her grandmother was spending $300,000 a year for long-term care. So think about, again, future cost of care. For most of us on the call today, we may need some kind of help, whether adult daycare, home care, assisted living, or nursing home, but we're probably not going to need it tomorrow. Where's that cost going to be in 10 years, 15 years, 20 years? And that's what we have to think in time. And on top of that, what would happen if we had an event in our life, and what would that do to our retirement savings? What would that do to our retirement income? Would we have to redirect some of what we saved for retirement in order to pay for our long-term care need? So let's talk a little bit about what your plan is. And before I get into these questions, I'll share my story of my family. My father, at the passing of my father, the day after the funeral, my mother and I We're going through some of the paperwork, some of the life insurance policies that my father had, looking at various pieces. And she said, I need to do something about that long-term, she called it long-term health care. And I said, well, explain to me why now, after all these years, I've tried to get you to look at something. Why now are you concerned about care? And she said, well, I'm all alone. And I said, you've got 3 sons, 3 daughter-in-laws, 9 grandchildren within 10 minutes of your house. You're the least alone person I know. And she said, well, no, now it's me. It's on me. I need to take care of myself. And I appreciate you boys were here to help with your father, but I don't want you to have to do that. I want to make sure I take care of me, and I set up a plan. So we certainly set her up a long-term care plan. Last year, 20 years later, she passed away without using her long-term care insurance. But you know what? She had started to slow down. And as my brothers and I spoke last summer, as we began to plan about what the next 3, 5, 7, 10 years might be with her, she was 82 years old. We were thinking, hey, there may be assisted living. Maybe she will come live with some of us. Maybe she will use home care. And certainly having a plan already in place certainly made it easier for us as a family to make the decisions about how we do with her care and where she'd like to be. And so we will ask people to think, do you think you're going to live a long life? Do you agree that the longer you live, the greater likelihood your health could become compromised and you may need some extended care? And then most importantly, if you needed care, would that have an impact on those around you, your loved ones? And I always say to folks, when it comes to long-term care is a family event. It can't be helped. The loved one who needs the care never actually coordinates the care, oversees the care, makes sure the care is going right. They're the one receiving it. And as Michael said a little bit earlier, he's right. Usually a family member gets drafted to step in and help out. Maybe they're even given control of the checkbook. Tends to be a daughter. My experience is it's usually the daughter that lives closest. But then decisions have to be made. And what I see when it comes to a long-term care event, if a plan is not in place, and it doesn't have to be insurance. I mean, you can say, I've designated some dollars over here, or, I want to liquidate these assets in order to pay for my care. My experience is that families tend not to get on the same page when it comes to all the decisions that have to be made, the plan of care, the type of care, how much care. And if there's not a prior plan in place, then family members sometimes get at odds with each other. They mean well, but everybody has an opinion. And so when you're thinking about long-term care, please think about longevity. Please think about what the future cost of care is going to be, but also think about if you needed care, how would that impact those around you? So let's quickly go through Medicare and Medicaid. And I want everyone to understand that Medicare is going to be a federal program that most of us are going to qualify for at age 65. And Medicare is skilled care. It's not custodial care. Medicare won't reimburse you if you're 92 and you have arthritis and it's hard to use your hands. If you have difficulty going from the bedroom to the bathroom into the kitchen or the dining room, Medicare is going to reimburse for skilled care. Maybe you've had knee replacement surgery or hip replacement surgery. Maybe there's a stroke and you have speech therapy. But Medicare is going to help with skilled care and only start after a 3-day hospital day, and they do not count your intake days. So you're there 4 nights before you even qualify for Medicare. Medicare will pay for the first 20 days. You have a co-insurance from day 21 to 100. And at day 100, you're done with Medicare for that particular condition. As I tell to people all the time, this is not long-term care. It's a limited skilled care benefit for those on Medicare. Often people will confuse Medicaid and Medicare. Please don't. It's 2 entirely different programs. Medicaid is a federal state partnership administered by states, but often funded by more than 50% from the federal government. And it is our social safety net when it comes to long-term care. It requires you to spend down your asset, the recipient's assets. In most states, about $3,000 in assets. And here is something that is really critical for all of us out there who have a lot of your assets in 401ks or IRAs, but qualified funds. Qualified funds are countable assets for Medicaid, meaning that if most of your retirement wealth are in IRAs and 401ks and you have a long-term care event, you are going to be forced to use those taxable funds to reimburse for long-term care. You can't put it in an irrevocable trust. You can't hide it from Medicaid. So I'll go back to the first bullet saying that you've got to spend down your assets. You also have to agree to income limits, anywhere from $100 to $120 a month. I had a younger brother, unfortunately, after a long bout with a malignant brain tumor who ended up in a Medicaid facility. His income was $60 a month. You go where there is a bed available. Just because you spend your assets down and agree to the income limits doesn't mean that you're going to get the facility that you want to get to. Some people ask me, hey, will Medicaid provide home care? Some more and more states are experimenting with it, but if they do, it's 2, 3, maybe 4 hours tops. And again, if you've taken some care of a loved one at home, you understand that 3 or 4 hours a day doesn't even allow you to get a good night's sleep at night. Remember that there's a 5-year look back on asset transfer. So if you go to try to qualify for Medicaid, the first thing that the state of Tennessee is going to do is they're going to ask to look at your checkbook, your savings accounts, your investment accounts, any kind of asset that you have that you may have transferred in that 5-year period of time. They're going to ask you about it. I, until COVID, did a lot of public speaking on long-term care throughout the United States. I often do them with estate planning attorneys or Medicaid planning attorneys. A lot of the attorneys out there would say, boy, my state's getting really, really tough on the 5-year look back on asset transfer. In fact, the last one that I did in the state of New Jersey, the attorney said, I just had a hearing yesterday and they're going through all the canceled checks of my client and they pull one out that's $200 made out to cash to the daughter. And they're saying, what's this $200 for? And the lady said, well, it was 4 years ago, but I feel pretty certain it was made out to cash to have my daughter go to the grocery store for me. And the response from the state was, well, where's the receipt from the grocery store? Well, who keeps receipts from a grocery store more than 4 hours, let alone 4 years? So understand that it's very difficult to hide assets. And ultimately, assets can even be recovered after death. So in situations where you have a couple where one of the spouses go into a Medicaid facility, the other spouse stays in a home, but even after that second spouse is passing, the state can come in, seize proceeds from the sale at home in order to recapture the money made out for Medicaid. The Medicaid system is our social safety net. Glad we have it, but understand that as a planning tool, there are hoops that you're going to have to jump through. So I'm going to make a quick transition and I'm going to explain to you how the private long-term care options work. You might think to yourself, well, which one's for me? I don't know. And the reason I don't know is we don't know enough about you. Certainly, but understanding how these options work, I think might help you in the future trying to figure things out. There are a couple of things about private long-term care insurance you need to understand. First and foremost, and the most important thing is all qualified long-term care plan benefits are income tax-free, both at the federal and state level. In fact, if it was up to the states, all of us would have some kind of private long-term care option because they're worried about trying to pay for everybody on the Medicaid system. And there are two ways to collect benefits that will be certified by a medical professional, usually your physician. If you can't do 2 of 6 ADLs, there's that term again that I mentioned earlier, activities of daily living, which again is eating, bathing, toileting, continence, transferring or dressing, activities that you might normally do within the home. If you can't do 2 of 6 ADLs or have a cognitive impairment, which is usually Alzheimer's or dementia, certified by a medical professional, usually your physician, then you would begin to collect your income tax-free benefits. So there are 4 different types of long-term care plans out there that I will get into in a little bit more detail in just a moment. Standalone, which is kind of a pay-as-you-go process. A linked benefit life hybrid that combines life insurance and long-term care. A linked benefit annuity option that creates an annuity that also has long-term care benefits. And then an accelerated benefit life. So if you decided to have a permanent life insurance plan that you put a long-term care rider on it, you could actually take your death benefit out at an earlier time to help reimburse for long-term care expenses. So I'll start and get into a little bit more detail on the standalone. Understand all of these plans cover adult daycare, home care, assisted living, or nursing home. The insurance company cannot say to you, oh, well, we approve your benefits, but you have to go to a nursing home. You decide where you want to go. As I mentioned a little bit earlier, most people choose home care. But with your standalone, you select either a daily or a monthly benefit, a 2, 3, 4, 5-year plan. You have inflation options, either 1% up to 5%. Most people will pick a 3% compound inflation option. You have an elimination period that for most of us who are familiar with health insurance, you have a deductible. Well, an elimination period is deductible for long-term care, but it's in days. And so instead of an amount of money, usually you pay the first 30, 90, 120, 180 days, and then the insurance company steps in after you've been approved for your plan. And then the last thing I'll say about the standalone long-term care is if you're doing research, you're going to find a number of articles out there about the traditional long-term care plans have gone up in rates over time. And that's true. But my bullet point of recent stability says, but those are the plans that were sold 15, 20, 25 years ago. Benefits today are lower, premiums are higher, and I think companies have done a much better job of pricing the risk that will lead to better stability of the rates going forward with a standalone plan. The second long-term care plan that I talked about is the linked benefit life hybrid. Now, in the first plan, the traditional standalone long-term care plan, that's a premium payment that's done every year of your life. So if you bought a plan at 40, you may pay it until you're 80, 85, or 90. In fact, I actually have 2 of the first types of plans that we talk about, because when I bought my first one at 38, that's all that was available to me. So I pay a premium every year. And some people, though, said, well, what if I pay that premium every year, don't use it? Well, that's where insurance companies got together and decided to do that combination of life insurance and long-term care. In some cases, people will take cash value out of policies and move it into a plan like this. They'll take some savings and move it into a plan like this. So they're going to create some your leverage. But when you need care, they're actually going to draw down from your life insurance amount first, and then they're going to have additional long-term care benefits on top of it. But if you don't use any long-term care benefits, or you use very little long-term care benefits, then the life insurance portion of this contract will pay back your estate the monies that you've put in. So you are guaranteed to get money back, either through income tax-free life insurance or income tax-free long-term care benefits. And my last bullet is the indemnity lifetime. So some of these linked benefit life hybrids, instead of reimbursing your long-term care bill, say you decide to get home care, so you have a home care agency come into the home, you pay the bill, you then submit the bills to the insurance company, they reimburse you for it. Some companies, instead of doing that, will actually just give you an income tax-free check each month for you to spend any way that you want when it comes to long-term care. Those income tax-free checks right now could go up to almost $13,000 a month that you can receive. You spend the money any way that you want when it comes to long-term care. You want to pay a loved one or a child to help watch after you, you can do so. And again, you'll pay no tax on the dollars. The other part of that bullet is lifetime. Some people worry that Alzheimer's, dementia actually run in the family. So you have the ability to create a policy that would last as long as you need it. So if you need help for 3 years or 13 years, the benefits will be available to you. Let me give you a quick example of this type of coverage. This happens to be a 60-year-old non-smoker male who's from the state of Texas. This individual could move $100,000. Now they could do it over 10 years, over 20 years, over their lifetime. They can make a deposit of $100,000. By the time this individual was 80 years old, they'd have $900,000 of long-term care benefits paid out at $9,100 a month. And it would come with a $100,000 death benefit so that if you don't use it, you get all your money back. And this is an example of how this works. So you can see that in this particular example, I used it as a one-time payment of moving $100,000 into this concept. It creates $100,000 of a death benefit, but over $900,000 by age 80 of long-term care. If this individual can't do their ADLs or have a cognitive impairment, the insurance company is going to draw down the life insurance benefit first. Well, if you put $100,000 in and you draw down the $100,000 worth of life insurance, you're basically getting your money back. So what this does is it creates a high deductible long-term care plan. So when that $100,000 is exhausted, you still have a small residual long-term or life insurance benefit of 5% of the total amount. So 5% of the $900,000. But you see that you put the money in, your money comes back first, but then you've got an additional $800,000 income tax-free to take care of your long-term care bills. You can do the same thing with annuities as my previous example. They just use an annuity to combine with long-term care. Now, in this particular situation, you can add your spouse to it. So I do see situations where maybe somebody has a non-qualified annuity, they don't know what to do with it, or they're not using it for income. They just say, hey, can I take this, put my name on an annuity in long-term care, and then add my spouse to it so that we both have coverage? You can do so. Also, if you do use an existing annuity, if you've got a gain in it that is usually taxed when it comes out, that'll be taken out income tax-free to use for long-term care. And again, you retain your control of your assets. So if you don't need any long-term care benefits or very few long-term care benefits, then the annuity passes on to your heirs, just like any other annuity. And then the last example I'll use is putting a rider on traditional life insurance, whether it be a universal life, a whole life, some kind of permanent insurance. And you can spin down your face amount of your policy if you need long-term care. If you can't do your ADLs, you have a cognitive impairment. So let's say that you had bought a $200,000 permanent life insurance policy with a 2% rider. Well, 2% of $200,000 is $4,000. You can't do your ADLs or you have a cognitive impairment. Then you take $4,000 out the first month, the second month, the third month. So your face amount of your policy goes to 196, 192, 188, and so on. And let's say you get down to $100,000 you pass, then that additional $100,000, the amount that's left over, the $100,000, will then move on to your heirs income tax-free. So I kind of quickly went through 4 separate different ways to create a plan for long-term care. They all trigger benefits the same way. All the benefits are all going to be income tax-free. It just depends on what kind of chassis, if any, you decide to do so. But I tell people all the time, 20 years ago, if you looked at a long-term care insurance policy, the first option was all that was available. In today's world, there are 4 different ones. And so the long-term care insurance part of the process, or the planning process, has become certainly a planning process, and with the options that are out there. So at this, I'll turn it back. Yes, was there a question?
Yeah, I have a question.
Mhm.
Is it possible to get a copy of your slides?
Be happy to.
Great.
I can
Yeah, Brian, Brian, just send me the slides. I'll send your presentation along with the other ones.
Yes, I'd like copies of slides from all the presentations today.
Oh yeah, absolutely. I'll do that and the video as well, Marty. So you'll have everything.
Thank you.
Okay, great. Brian, if you want to stop sharing your screen, I have a few questions already, and then we can, so basically we're at the question and answer part. We do have an attorney joining us, just if any legal issues arise or there are questions about the legalities of any of these pieces. So her name is Kim Span, so she's joining us on the panel. She has 33 years of experience in estate planning, real estate law, and litigation. And she has worked for the Tennessee State Attorney General's office and is on the board of professional responsibility. Ms. Span is currently a partner at Adair Span PLC, where she assists in estate planning and real estate transfers, and is a member of the American Bar Association and the Real Property Trust and Estate Law section. So I just wanted to welcome Kim to the seminar. We do have some questions already that people have sent in. So I'm gonna go ahead and get us started. We do go to 1:30, so it will be a hard stop if we don't end before. So one of the first question was more about the first presentation. And they said they appreciated the different sort of tools that can be used to get the next generation engaged. And they're just asking, and this is for any of our panelists, Eva included, obviously, but is there one way, I think they're talking about the donor advised funds or the charitable lead trust, or is there one way that is more successful or more popular, with getting the next generation involved than others? So that was the question they had.
Well, the donor advised fund is the simplest to operate because you individually would not have a tax filing requirement on an ongoing basis, where the others you would have tax filings in it. And of course, you've got the fees to pay for preparing the tax returns. So that would be that much less to go to charity. Popularity, we do see more charitable remainder unit trust than we do charitable lead trust. There seems to be less lead trusts out there than the remainder trust. It's hard to say which is more popular. I'm just going by the ease of operation. The donor advised fund would be your easiest route.
Sure. Kim, just if you could comment, when you have had clients come in to do some of that estate planning, do you set up a lot of those charitable lead trusts to get next gen involved?
I don't see as many charitable lead trusts as I do charitable remainder trusts, honestly. So I don't know if maybe Dave has a different opinion on that. I see he's here. But honestly, more charitable remainder trusts, or even specific designated amounts, upon the last of a grantor to die. I see that even more often than charitable remainder trusts, honestly. Those are all viable vehicles, to show that you have a giving nature and to let the next generation, participate.
And just a reminder to those joining us, the charitable remainder trust is where a designated person collects income, and then when the trust expires, either through death or a certain amount of time, the charity gets the remainder of the money. So that's what Kim is speaking about. David, did you have anything to add since you're here? Okay.
Would you agree with that, David?
Yes, exactly.
Okay. So this next question was about our second presentation. Is there an age that is recommended to get long-term care? Like, when is the best time?
Brian, let me start for just a moment on that.
Sure.
And then you take over. I find that younger and younger folks are interested in long-term care. And I had one case of a mom who got an annuity type policy, and then she passed away. And the daughter, who is in her late 20s, actually mid 30s, said, I want one of those. And I want that because it gives me long-term care. She had a relative in Boston who was hit by a car at an early age. And actually, she was too young to get that kind of annuity-linked life long-term care policy.
Yeah, that Michael's absolutely right. Younger and younger people are beginning to look at it because they have family events that they observe or folks around them. I would tell most people sometime in the mid 50s, as people are beginning to make that transition from, okay, hey, I've taken care of the kids, or I see that they're about out, and now I'm looking for myself and my spouse about how retirement is going to plan, and where does the potential of a plan for long-term care fit within that.
So I had someone different ask this, which I think was just kind of funny. When is it too late to get long-term care?
Yeah, so you can actually find a policy up to age 85. I would say to you that all of these companies will look at your health history. And so, sooner rather than later when it comes to a plan. I will say this, I do get calls usually every couple of weeks. Mom's still going strong. She's 79, 83, 77. And the kids have, hey, mom's going to live another 15 or 20 years, but she may slow down. And so I get the call and, is there a solution for it? And there is.
I have one other thing I'd add to that. Oftentimes people in the insurance area say, if someone calls me, it's typically too late.
Yeah, I can understand. So another really interesting question that I got was, how much money can you have, like in your sort of estate or assets, where you wouldn't need long-term care?
Well,
That's a surprise.
yeah, so I've dealt with some pretty high net worth individuals.
Well, I mean, I can spend some alone time.
And so what I would say about that is always remember that individuals with a fair amount of assets like to get the best coverage or the best care, which will probably be at home, which if you got 24/7 care, if you just use the number that I put in front of you a little bit earlier, you'd be looking at around $175,000 to $200,000 a year today. And in 15 years, 20 years, you'd be looking at $350,000 to $450,000 to $500,000 a year. You can pay that out of your pocket. I will tell you, when I meet people at 7, even 8, 9 figures, 10 figures, that have gone through something like that, they're usually the first to say, hey, I want to put a plan in place to do that. Yeah, I wrote the check, but if it was up to me, I'd rather have somebody else pay the bill.
And I was just curious, Kim, now that this question was asked, have you seen, as far as when you're developing estate plans for people, do you see sort of a cutoff point, where they have a certain amount of assets and they're just like, I don't need them anymore? I was just curious.
What I see is it depends on the people's goals and their comfort level. I do try to point out the cost, which is just, increasing, as Brian has pointed out. So when I meet with my clients, asking them whether they have long-term care insurance is one of the questions that I go through, to determine, but I don't see a cutoff exactly. It's more that person's risk aversion, or whether they're, really concerned about protecting what assets they have to pass on to the next generation rather than going through them for long-term care costs. It's one of those, it's a very personal decision, but I always recommend long-term care to just about everybody I talk to, regardless of how wealthy they are.
Yeah, Shannon, let me share a quick story with you that happened last year, 2 years ago with a loved one that I talked to 22 years ago about long-term care planning. They decided not to, and I respect that. Our discussion today is not, oh, you have to buy I think you should have a plan. I'm not sure that you have to buy insurance, but that person decided not to. And the day came for him to move from his house into an assisted living facility, and I was helping him to move. He asked me to sit down, and he said, do you remember those conversations we had all those years ago? And I said, yeah, I do. And he said, would you like to say, I told you so? And I said, no, I don't do that. He said, well, I don't know much about long-term care or long-term care insurance. He said, but as far as what I'm experiencing, here's what I know about long-term care. Today, I have no mortgage. Starting tomorrow, I'm going to have a mortgage of $8,700 a month. That's what happens to people without prior planning when it comes to long-term care. You go from 0 to 60 really quick. And the panic phone calls I usually get from family members, usually the kids, which is, it's here, it's right in front of us right now. It happened over a fairly quick period of time. We're not prepared for it. And our only option is a checkbook. That's not the way to plan when it comes to long-term care.
I think that's
Brian.
well put. Michael, you had something to add?
Yeah, just Brian, add a little bit more, I think, as a repeat on tax efficiency and how that may free up dollars that could be passed on to charitable intents. Can you explain some of those opportunities, Brian?
Yeah, well, at the very basic part of it, as I mentioned before, I think multiple times, long-term care benefits are income tax free. I've seen some people use the hybrid long-term care option and put there are some of those policies you actually can put into a trust if you decide to do so for efficiency. So again, occasionally I'll hear some people will say, well, maybe instead of allocating those dollars for long-term care, I'll invest it over a period of time, and then I'll have a nice nest egg to pay for my long-term care. My response to that is, you can. I advocate doing a plan. It's different for everybody. But when you do so, you're going to be pulling out taxable funds to pay for a higher amount versus using a plan in front that the government has said to you, because you did some prior planning, we will let that be income tax-free benefits. I think it goes much further.
Great. I just wanted to open it up. If anyone else had any questions, verbal questions are open. I'm done with the questions that I have. Just wanted to give people a few seconds to unmute if they wanted to ask anything. Okay, great. So I'm gonna.
I'll add one thing.
Oh, you had something, Michael? Go ahead.
Yeah, it comes back to the time when I started in long-term care, which is 2003. I remember being really impressed that there were 5 states, California, New York, and Brian will know the other 4 states that were desperate. In California, it was their Medicaid problem. And the state was realizing we're in trouble. Folks are going to think, well, all you need to do is not have much money and then we'll pay for your long-term care. And the states were realizing, we're in real serious because we won't be able to afford that. So the states reach out to the insurance industry and said, we need a partnership. We need to make a plan that's going to be a very good, reliable plan. And if somebody chooses to have a plan of $300,000 and this is now a resident, they'll pay the money of a policy that'll give them $300,000 worth of benefits for long-term care. Well, we'll change that Medicaid from the $3,000. If they had $300,000 in the policy, that they can keep that, because we recognize that they're taking responsibility early on. Partnership policies are still available. They're available here in the state of Tennessee. And a problem that the industry went through, and I think is coming out the other side, is the partnership required a 5% compounding, and that finally went out the roof and being overly expensive. So this is an issue that has a long history of struggles at the level between the states and the social network and how they can help people.
Thank you, Michael. I actually want to thank Eva Pulley, Michael Whitney, and Brian Langdon for presenting, as well as Kim Spann for being on our panel. I wanted to thank all of you for being here today, and the Jewish Federation, Jewish Foundation of Nashville, Middle Tennessee, and the Joe Kraft Professional Advisory Program Fund, and the Harris A. and Diane Gilbert Area of Interest Fund for education for supporting today's program. I will be sending a follow-up email with the video and materials. And thanks again for joining us, everybody. Have a great day.
Jerome has a question, it looks like.
Oh, I'm sorry. I was like reading and not paying attention. Jerome, is this Mary?
Okay.
Jerry.
I don't know if this has been answered already, but I would like to ask this question. We are 89 and 83 years old. We've paid into CNA for close to 50 years. I don't know exactly how much it is, but it's a sizable amount. We have been told that this is not the time to end up premiums. We are now saying that there are other possibilities. What alternatives are there for a person that has put in that much time, effort, and expense? Are there any other alternatives or suggestions that you can make, or do we need that now more than ever before?
Let me answer that. You need it now more than ever before. Under no circumstances should you give it up. You've made that investment into the policy. If you would like us to evaluate it for you and tell you what you have, sometimes people aren't quite sure all the bells and whistles. Let us know, and we would be happy to do so. But under no circumstance would there be anything out there that would be better than what you currently have.
Okay, thank you.
And
Jerome, you can get in touch with me and I'll make a direct connection to you.
Yeah. Michael, do you want to connect them? Okay, great. And so I've already, is there someone else?
I have a question.
Okay, now there are questions. We have till 1:30.
If we have time.
Yeah, go ahead.
Just, I thought it was interesting, the hybrid product you talked about, and I just wondered if that's something that is more specific for older people who do not have long-term care insurance. Is that an affordable product?
Yeah, I mean, affordable is relative to all of us, but we will often make that recommendation for somebody because again, you're trying to figure out how much you're going to allocate to your long-term care. So you like to be in a situation where, I always tell people, collecting it's not all that great. You're either going to be really sick or you're going to pass in order to do so. But at least either your state is going to receive the money that you allocated to it, or that you're going to get the care that you need. So yeah, that can be certainly an option for you, an attractive one.
Thank you.
You're welcome.
All right, before I conclude, is there anyone else? Okay. All right, great. Sorry, I didn't get any questions before. I thought we were done, but I guess now we are. If anyone has any questions, you all have my email. Please email me and I will put you in contact with who can answer your questions. I also have the roster I'll send out along with the materials with everyone's contact information. Brian's will just be at the Langdon's will be at the bottom of the email since he's not on our roster, but you will have his contact information as well. And I guess that's it. That's all she wrote, folks. So enjoy the rest of your day. And our 5th seminar is for formalization purposes, and it will be in May, at the beginning of May. And more information about that, if that's what you're interested in, will be sent out shortly. Again, thank you all for coming.
Thank you.